Okay, everybody, welcome. We're going to give it about another 30 or so seconds to let people flow in, and we got a lot of good stuff today. So I just want to make sure we are able to cover everything, and as well as get to Q&A. And it's recorded. So if anyone missed the beginning, then you certainly have the opportunity to watch it for the first time or watch it again. So welcome, everybody. My name is Peter Hans. For those of you who aren't familiar, I'm a Chief Strategy Officer at ARCA. I also run our IR and business development. So, to our LPs and clients, certainly know me and welcome. In our conversations externally, one of the things that constantly comes up when Jeff and I speak to prospective clients is, really how do you value this asset class? How do you look at intrinsic value? Whether it's the media or just kind of legacy thought process, there's a lot of view that this is essentially, Bitcoin and other cryptocurrencies, and there is no intrinsic valuation. And, we spend a lot of time one-on-one dispelling that and talking about how we actually look at the ecosystem, how we're able to, conduct fundamental valuation, how we're able to have price targets and models on what we invest in kind of our core fundamental strategy. So we thought it would be a good idea to host this webinar and really dive into a lot of those examples. So I'm really fortunate today to be joined not only by Jeff Dorman, our CIO, but also by our head of research, Katie Talati, and by two really talented analysts on our team, Alex Woodard and Nick Hotz. So with that, we're going to get started. I'm going to kick it first over to Jeff, and just to set a little bit of a background, we're going to walk through, really how we view the entire ecosystem. There isn't, a true taxonomy. There's no Morningstar taxonomy for the asset class. So we at ARCA have had to develop a lot of that. So Jeff's going to walk through a little bit how we view the space from the top down before we get into some bottoms up examples. So Jeff.
Sure. Thanks, Peter. And hello again, everyone. Good morning. Yeah, it's funny. All of us here at ARCA, who come from Wall Street, we all come from traditional backgrounds. Traditional valuation techniques is all we've known, from your Graham and Dodd equity valuations to your Frank Fabozzi fixed income valuations. And really, we can go back, I think 3 years ago, even I wrote, about valuing digital assets and how it's not that different from what we're used to in the traditional world. But 3 years ago, that was lost on most people because it was so new and everybody was so focused on Bitcoin. Over the last 3 years, we've made a lot of advances and strides with regard to that education process, as well as other funds and other investors out there starting to look at the world the same way we do. So to start with, before we could even get into valuation, the first thing we had to do was really understand what this universe looks like. We're all used to your Morningstar taxonomies or S&Ps, where everything's kind of mapped out for you, and we kind of take that for granted. But here in the digital asset ecosystem, not only was it not built, but it's evolving every week or every month, where we constantly have to update it. So the first way we started thinking about digital assets beyond Bitcoin was let's think of this in terms of the same way we kind of think about fixed income, which is, who is the issuing body? What does it look like? What other types of assets are out there? And I often use fixed income as the analogy just because it is so unique and so different, right? Everything from government issuers to corporates and munis to different types of bonds, from callables, convertibles, different covenants in the bond, different ratings, et cetera. That's kind of how we view digital assets. So the first and foremost is, again, we have to figure out who is the issuer of a token, right? Bitcoin was the first. Bitcoin is a decentralized currency. But there's all kinds of different issuers now. You have government issuers with these new central bank digital currencies. You have corporations, whether it's Binance or FTX. You have individuals. There's even an NBA player who issued his own token backed by his salary. You have what's called DAOs, or decentralized autonomous organizations, right? Where these are decentralized groups of people who are issuing a token on behalf of all of their members. And then, of course, you have your protocols, your platforms, your Ethereums, your Solanas, things like that. On the next slide, within that, you can also then think about, well, what is the governance structure? Is it something fully centralized, like an individual or a company that owns the token, or is it something fully decentralized, like some of the protocols and platforms or some of the currencies? And if you go down the list, we'll go to the next slide here, then you have to break through, once you figure out the issuer type, and once you figure out, where it falls on that decentralization spectrum, what is the actual asset, right? We're used to Bitcoin. Bitcoin is a currency. And as we'll go through this valuation seminar here or webinar, there really isn't a great way to value a currency, right? Whether you're talking about digital currencies or you're talking about, the yen or the euro, it's really mostly relative value, right? But other types of assets in the digital asset world, you can value much easier. And these are things like asset-backed tokens, which are exactly what they sound like. These are tokens that are backed by something real, right? It could be backed by a real-world asset like real estate. It can be backed by other digital assets. For example, Nexus Mutual, one of the companies we've talked about in the past, which is an insurance protocol. They have over $600 million of Ethereum sitting on their balance sheet, and the token is fully backed by that. And the token trades at like a $260 million market cap, so 45% of book value. And there's lots of other types of asset-backed tokens as well. And then the last category that we kind of lump everything else into, we call pass-through tokens. Really, the way we think of a pass-through token is it's some sort of a hybrid vehicle that is quasi-equity on one side, meaning you're actually getting the financial benefits of either that revenue or profits being distributed to you in some way, shape, or form, either through buybacks or through dividends or just through the growth of the company or project. But then there's also some sort of like loyalty or hybrid kind of membership reward part of it as well, where you're actually getting some sort of a utility or some sort of a use case out of the token, right? So similar to your Amazon Prime membership or similar to your Delta Sky Miles or your Starbucks reward points. But these tokens really encapsulate all of that all in one package. So, before we kind of get into some specifics here, this is why we always talk about digital assets really being, and Peter, you can go to the next slide, go ahead. This is why we always talk about the similarities between digital assets and traditional finance, because even though it is a hybrid, right? You have it's part loyalty reward or membership card, it's part payment vehicle, it's part investment vehicle. The investment vehicle part you can value the same way we always have, right? Again, I mentioned Graham and Dodd earlier, or Fabozzi's fixed income Bible. Those are tried and true methodologies for valuing bonds and stocks. But 100 years ago, those didn't exist either, right? Somebody had to write that book. Somebody had to convince the world that this is the way to think about present value of cash flows. Well, the same thing is now true of digital assets, right? A lot of these projects actually have real revenues and real cash flows, and that part of the token that can be valued as an investment vehicle is very straightforward, right? We have DCF models, we have dividend yield models, we have analysts who come from Wall Street or academic backgrounds who know how to model all these companies, and we do it in the same way. Like all of our investment memos, all of our models for that part of the token's value will look the same as a model that you're used to in the traditional world. The difference is we have to then add in other components to make up that other part, right? How do we value the payment vehicle part of it? How do we value the loyalty membership reward part? And this is where you get into new kind of digital asset considerations, things like Metcalfe's law, which if you're not familiar is just, how do you value a network based on the user growth, right? This was what a lot of technology analysts used in the early days of things like Amazon and Netflix and some other companies, pre-revenue, pre-profit. But also things like utility functions. Is this a token that could actually be utilized? For example, Binance is the Coinbase of Asia. Binance is, probably 3 or 4 times larger than Coinbase in terms of the trading that they do. But the BNB token, the financial part is easy. They have 20% of all of their profits that are used to buy back tokens, but they also have this utility feature where you can use the BNB token to get discounts when you trade on their platform. You can use it to as collateral to trade options and futures. You can use it to almost like a lottery ticket to get first dibs on new tokens that come to market on the Binance platform. And in some ways, it looks a lot like that Amazon example I gave you before, where Amazon Prime on one side is your member benefits. It started with just one thing, which was free shipping, but then it added free movies, free music, Whole Foods discounts, all these other added benefits, but then you had the stock totally on the other side here, and they were completely mutually exclusive. The BNB token does both. It gives you that equity upside of the profits, but also gives you that member benefit. So we have to come up with ways to value, well, how do you think about that member benefit? What is it worth to be able to get these discounts, to be able to get all these other member features of the Binance network? Similarly, there's supply sinks and amortizations and inflation that you have to work through. Terra Luna, which is something that people talk about all the time now, is a good example of that. Terra Luna is the layer 1 blockchain that issues the UST stablecoin. Well, for every dollar of the UST stablecoin that is minted, $1 worth of Luna is burned. So effectively, Luna is an amortizing token. Over time, it could go to zero outstanding Luna based on the growth of UST. So we have to take into account these supply sinks, these amortizations. So as we get into this, and I'm going to pass it over to my colleague, Katie Talati here in a second, as you get into these things, you'll notice that there's a lot of similarities to what you've always heard of, to what you know, to what every analyst on Wall Street has been talking about for 40, 50 years. But we do have to add in these other wrinkles. And these wrinkles is where the alpha comes from. If you gave 10 equity analysts the exact same inputs, they're pretty much going to give you the exact same output, right? Maybe a few tweaks here and there to the model. But if you give 10 digital asset investors the exact same inputs, they're going to give you wildly different outputs. And that's because these methodologies that we're creating and others are creating are just not necessarily homogenous yet. Not everybody's using the same models, and that's where the alpha comes from. And that's why we think this is one of the most attractive asset classes to invest from a purely fundamental standpoint. So let me turn it. Go ahead.
Jeff, before we move on, you threw a lot obviously at everyone and quickly. There's a lot of information here, but I just want to just take a quick step back before we move on, because I think that chart or graphic kind of on the left margin around the different features within a digital asset compared to, say, an equity is pretty important. And one way, one highlight that I think is rather helpful. You talked about the issuers at the beginning, right? If you're decentralized, then the token is essentially the only thing on the cap structure. But if you're talking about an issuer that is a centralized entity, does have equity, perhaps debt, we look at the token as just another portion of the cap table, and one that has very defined rights. It could be loyalty points. It could be, used as a method of payment. It could be, some sort of pass through or active yield. And, I thought maybe just quickly kind of elaborate on that, because, I think what you'll start to see in the future, we've already seen Starbucks hint at, in essence, tokenizing their loyalty program, things like airline miles. So United tokenizing their airline miles, where, you'll have a very specific use case for the token, but for a less mature business, perhaps there are different features that need to be worked into the structure of the token. So I just want you to highlight that quickly before we move on, because I think it's a really important high-level point.
Sure. Yeah. So some people have probably heard me say this before. So apologies for being repetitive, but the way I think about it is, your equity is your claim on profits, right? Or the difference between your assets and liabilities. Your debt is your claim on assets, right? Which obviously comes much more into play if there's a bankruptcy or a recovery scenario. The token is really a claim on customer growth or network growth or even intangibles. This is where that membership loyalty comes from, right? Think about how loyal the Starbucks community is, or how passionate, the people who have United Airlines or Delta Airlines miles, or even, you're getting into something like a Disney. How much would Disney intangibles worth if you had a Disney membership token with all the things that Disney has, from rides to Disney Plus to, the IP of all of their characters and all that. So we think of a token with regard to a company as the issuer as really the third part of the capital structure, something that can tap into these intangibles on the balance sheet that right now ascribe no value. And more importantly, what it's really doing is it's starting to align all of your stakeholders, right? The reason I like the Amazon example so much is that, you can be an Amazon customer without being a shareholder, and you can be an Amazon shareholder without being a customer. There's no real tie between the two. But if there was an Amazon token where it was set up, let's say the exact same way as the BNB token I was describing, where you get 20% of all profits dividended back to you before it goes to the equity, but also you get all those same member benefits, you could come up with a world where that Amazon Prime token is worth way more than the equity, just in terms of the value you're getting and the utility from it. And then you go down the list and you look at all of the companies that aren't taking advantage of this. Like I always use Airbnb and DoorDash as example, right? Airbnb has $100 billion market cap, of which maybe 10 or 15 venture capital firms got all of that money. None of the people who made Airbnb possible benefited, right? Those are the people who own houses, the people who vacation in houses, right? Hundreds of millions of customers and users who made that network possible got no benefit from the Airbnb price appreciation. Same with DoorDash, right? People who cook food, people who eat food, people who ride bikes and deliver food, got no benefit whatsoever. McDonald's, we look at the demographics of McDonald's shareholders compared to McDonald's customers, right? You have this big gap right now between those who make a company work and profitable versus those who actually profit. And I think if companies start unlocking this through their capital structure, it is going to add a tremendous amount of market cap or enterprise value to the overall company when you combine their debt, their equity, and their token value, and also start to align their stakeholders in a way never possible before. And that's just talking about public companies. Wait till you go beyond that and you start talking about universities issuing tokens, or municipalities issuing tokens, or your local bodega, or your local hairstylist, and all the little things, the little small mom and pop businesses. When they start aligning their customers to the actual profitability of the business, you just unlock a tremendous amount of value. And that's really the world that we see coming. And we're excited to invest along those as we see more and more opportunities like that.
Perfect. Thanks, Jeff. I appreciate you delving into that a little bit. So now I'd like to kick it over to Katie Talati, who is our head of research, and really runs not only does outstanding work herself, but runs our entire team and really implements all of our processes and the way we think about valuing different aspects of the ecosystem. So to start, we think this is an important one because everyone, it's a little bit of a hyperbole, but kind of not really, is familiar with Bitcoin, and there's a lot of thoughts around how to value Bitcoin, and our approach is it really kind of sits on an island by itself, and it's the one thing that we would ever have exposure to that we don't have a model for, which Jeff says a lot. So Katie, maybe elaborate a little bit on Bitcoin before we get into the more kind of meat of what we're here to talk about.
Of course. Good morning, everyone. So I really want to kind of emphasize that, definitely the title of this slide says it all. Bitcoin is the anomaly rather than the standard. It definitely is the outlier rather than the rule. I would say probably the most common question I get, or the biggest, digital assets fallacy that I hear again and again and again is, well, digital assets, there's no way to value them. There's no intrinsic value. There's no earnings. And so why should I invest in them? Unfortunately, I definitely respect that Bitcoin has totally set the stage for digital assets. It's brought a lot of people into the ecosystem. It's been around for a long time, and it is the standard for the technology. However, I think the inability to value it and have a universally accepted valuation method has, definitely kept a lot of people out of the space because they haven't explored further down the stack. So just kind of to explain to you guys, for those who are not familiar, what, kind of is around in terms of valuation for Bitcoin today, but there is no universally accepted method. As Jeff kind of mentioned previously, you're trying to value a currency. It's fairly difficult. There is relative value to, other currencies out there. Obviously, you can measure it against the US dollar as a big one in terms of, inflation protection. You measure it against gold. But it does, we hear that it lacks intrinsic value. And we really do want to debunk that myth that it applies to every digital asset. And in fact, I would even argue that the reason we don't have a valuation method for Bitcoin specifically is just really a lack of data. The ability to backtest some of the existing valuation methods really is limited to the amount of data there is on the Bitcoin network. And that really only stretches back to 2009, which really was only 13 years ago. And if you look at the valuation methods from Graham and Dodd, those were back tested over, many, many decades of data before we were able to kind of come to a conclusion that, you could apply these, valuation methods here and not here. Just so everybody is aware, there are some valuation methods that you may have heard of that may be floating around out there. One of them is called market value to relative value, MVRV. There's also spent output profit loss, SOPR. And there's another one, stock to flow. That one actually broke, I think, after the last Bitcoin halving, but it was kind of based on the Bitcoin halving cycle. So those are some interesting metrics, and we definitely look at them. They're definitely not disregarded at all, but we kind of use them as a guide and definitely much less of a rule to kind of dictate our investment in something like Bitcoin. But again, I definitely want to stress that Bitcoin and other traditional cryptocurrencies, such as, Ripple, Monero, Stellar, Litecoin, any of the, tokens that are really just meant to be a medium of exchange, those are very difficult to value. But that does not mean that the rest of the digital asset space does not have a set valuation method. And in fact, you're going to hear now from a couple of my analysts and myself as we kind of walk you guys through how we think about digital assets and how to apply a valuation framework to kind of each area of the asset class.
Beautiful. Thanks, Katie. So, as Katie mentioned, I'm going to kick it over now to Nick Hotz on our research team. And everyone is, usually we hear about Bitcoin and then ETH, which is obviously a different layer one blockchain or network, which many might perceive to have attributes similar to Bitcoin in that it is difficult to model or have intrinsic value, which I think was potentially true in the past, but is changed a lot over the past year or so, and I think we'll continue to see a change with proof of work. And Nick, I think, has a really incredible framework for how we look at these various layer one protocols and compare them. So kick it over to someone far more knowledgeable than I.
Yeah, good morning, everybody. And I definitely saying in the past, layer one blockchains, there really wasn't a way to value them. They are cryptocurrencies, but they also are more and more becoming pass-through tokens. And so you get this element of value that goes along with it. So as Peter was saying, even Ethereum, there wasn't a way to value it prior to, last August, when it put into place a mechanism by which token holders can actually accrue value from the token. And you see this coming with a lot of other blockchains that are proof of stake, for example, where they're returning some issuance to the token holders via staking. And you've kind of had now going from where there was really no valuation method that investors used to a kind of split between two different ways. And one group kind of values blockchains as businesses. You can think of them as more traditional value investors. They're looking for defined cash flows, product market fit, business, like a strong business model that they're thinking about blockchains as a business that sells blocks. The other group is these kind of growth investors that are looking to blockchains as kind of more of like a network or even like a nation. So they're looking for growth in metrics that are most kind of tangible indicators of activity. So things like active addresses. Total value locked is the amount of money that's in smart contracts on these chains. And honestly, whereas value investors would look at chains having a lot of people spend gas fees, so payment to use their smart contracts, as a good thing, growth investors think they're bad, right? So if gas fees are high, if people have to pay a lot to use the chain, that's a hindrance to people using that chain and to accruing more people, more users, more customers on that chain. And I just want to walk through on the next slide a bit of a difference between a couple of the different chains in the space. So we mentioned Ethereum as one of them, and Avalanche is another one. So I think the kind of value investor mentality was the more pervasive view going into kind of 2020 and even into 2021. Where Ethereum kind of had that mantle at the beginning. And you can see I've compared a list of digital asset metrics, the metrics we would talk about, and give a close enough proxy for the kind of traditional network metric that we would look at. So just for context, Ethereum is about 20 times the market cap of Avalanche. But you can see the fees that it's generating are much greater than 20 times as much. And so I go down some list of this statement, but what really I want to draw a couple things to the fore here. So one is the security rewards. So you can see Ethereum is issuing ETH tokens to pay for its security. This is about 17 billion over the last quarter, and Avalanche has issued 8 billion. So, you know, on a relative scale, when Ethereum has 20 times the market cap and is issuing about 2 or 3 times as many rewards to pay for its security, you know, clearly Ethereum is able to bootstrap itself more easily than Avalanche is. And you can see going down to the net burn per token, kind of like free cash flow per share. You know, Ethereum, each token is worth over $3,000, Avalanche $80, yet the amount of token burn is just about 3 times as much. Going down to like net burn as a percent of market cap, it's kind of like free cash flow to market cap or to price. You can see Ethereum is only spending 2.3% of its issuance to pay for itself, whereas Avalanche needs 35%. And we can look at things like price to sales ratio, market cap to fees. Ethereum is trading at a cheaper valuation based on the revenues that it's getting to the blockchain. But the curious thing in 2021 was that was not a driver of the price. If we go to the year over year change in price, Avalanche grew a lot more as a network, and the price of the AVAX token grew a lot more. Why is that? You know, you can see like growth indicators, active addresses, and fees for Ethereum were kind of flat essentially for the year, whereas Avalanche was up in the thousands of percent. And investors were rewarding those as, you know, it views Avalanche as a growing network and potentially able to get these cash flows that, you know, the more value side that Ethereum has currently. And I would note that both of these are kind of on the cusp of, especially Ethereum, but Avalanche too, on the cusp of getting to the point where they're no longer operating at a loss, especially Ethereum after its upcoming merge upgrade will almost certainly be operating at a gain. And that's what investors are looking to as kind of profits to on their investment.
Let's just touch upon that really quick, because obviously if you own, you know, equity in the Ethereum network and you have the upside available to the growth and the business value, that's very positive. In the sense of a token, yeah, how do you think about the meaning of kind of profitability or lack thereof? Because if the utility is there for the token and the market dynamics or way in which the token is structured is such that, you know, so long as the network grows, the token value will grow. Like how do you wrestle with that in your mind?
Yeah, there's 2 primary ways which a token, or at least a layer 1 token, can accrue value. Either the blockchain is going for a deflationary monetary policy, so that means that they're taking more tokens out of circulation over time. So per unit of price, there's fewer tokens, which should make the price go up, or they're returning new tokens to the stakeholders of their utility token. So if you're, for example, staking Avalanche tokens, you can get paid an issuance rate, which will, so maybe it's 5% per year. You get that 5% extra AVAX tokens over time. And so if there's doing enough of that where you are accruing more tokens than are being issued, you're kind of making a gain on the total number of tokens, and you can say you're accruing a sort of cash flow in a sense. You can relate it to an equity paying out a dividend yield, that's the staking yield, or doing a token or a share buyback, that's the kind of deflationary monetary policy.
Perfect. And it's probably a good segue now. I mean, we do have a Q&A tab that you can see in the bottom. You know, we got a lot to cover, so I certainly can't promise we're going to get to everything. But as questions come up that you know, flow naturally into discussion, I'll try to introduce them. You know, Nick, on the previous slide, we talked about you know, TVL is one of kind of the valuation methodologies, or basically looking at the value locked on a chain to determine, you know, how widely it's used. Pretty good question came in. I thought, do we look at, kind of do we differentiate between quality of TVL, or can you, or is it really just an absolute number? Because, there certainly could be incentives in place to grow TVL really quickly, but perhaps it's not sticky, or look at, other ways in which we look at the quality of the TVL and differentiate it, almost like evaluating one business's customer base versus another.
Yeah, and we use a provider called DeFi Llama, which is they do a very good job of kind of differentiating between these. There are definitely ways to differentiate between quality. For example, if you have staking in one platform and it's doing some sort of liquidity provision, there's a lot of ways at which the money kind of gets mixed up in decentralized finance, but you're able to extract the kind of pure money that's going in, and you can get a much more high quality signal from that data when you kind of know what to look at within that.
Perfect. Well, thanks, Nick. Yeah, very interesting, and obviously, it's a space even within layer ones that's continuously growing and adapting, and a lot to keep track of. So, with that, we're gonna move back over to Katie and touch upon another sector or theme within the overall ecosystem, and this is one that I'm sure many are familiar with here, is Web3. Before kicking it over to Katie, I'll just highlight this by essentially, we had the advent of the internet. Obviously, you're Web 1, right? You go to a site, you read an article, it's kind of a solo endeavor. Web 2, as I look at it, your kind of advent of social media, where everything is free, but the product is really your own data, right? Facebook, Twitter, Instagram, monetizing your browsing and what you do on the internet. The thesis behind Web3 is in essence to, like much in digital assets with tokens, is to align the incentives between the consumer and the organization or the business. So Web3 aims to put you as the user or the consumer in control of your data, of your activity as a consumer, and by aligning those economic incentives and other sorts of incentives, the idea is that the consumer will benefit incrementally, have more transparency, and the businesses will grow because they are economically incentivizing the customers to use their products or use their services. So I don't know if that was accurate, Katie. That's the way I think about it, but we're going to kick it over to you now to talk about this world and ways in which we value the different players.
Sure. So yeah, I think that the term Web3, at least right now in digital assets, is definitely kind of a catch-all for a lot of projects that don't necessarily fall within decentralized finance or the gaming landscape or any of kind of the consumer, consumer or layer one protocols that we're kind of familiar with. What we're kind of talking about today is that I would say that Web3 is still developing as a subsector within digital assets, and we're still kind of defining what it means. And I think within Web3, like I said, because it's a catch-all, I don't think it's actually, as even focused as something like decentralized finance. I think that within Web3, there are a lot of different offshoots. Even just from this slide, like we've got 5 very different companies on here that represent pretty different areas, but I can definitely dive in. At least within Web3, you can have projects that are not really necessarily defined like a Chili's, where you're really going for the network effect that a project like this will have that's very consumer focused. It's focused on an entertainment vertical, specifically sports. And their goal is, to kind of capture that entire fan base market. On the other side, you have what I would call definitely more infrastructure level plays. That is things like Arweave, Akash, Helium Network, and the Graph. And to give you guys an idea, these types of projects are going for just incredibly massive TAMs that, even when we write them down, multi-trillion-dollar market is, even though it sounds kind of ridiculous on paper, that is the way to describe what the sector that they are going after and the market potential. And so, they're really disrupting kind of these traditional layers of the technology stack that have previously been centralized. Arweave, for example, I'll talk about it more in the next slide, but that's decentralized storage that is really trying to take on someone like an Amazon Web Services. The graph is, they're trying to index every piece of data that is on the blockchain among all the blockchains. And so in a sense, they are trying to be Google. Helium is looking to completely disrupt telecommunications for 5G and the Internet of Things. Akash, cloud computing, that's basically, basically hardware space on everybody's computer. So these are really, really giant markets that, in a sense, even though they even have a large TAM, defining them either sounds ridiculous or we can't define them because they're so big and usually dominated by such large players. And so I think that when you're kind of thinking about Web3 and how to value them, you have to think bigger because you're going to be looking at not only, what is the network effect of like when you get to, millions and millions of users for these types of products. But these are also the types of products that are going to be running in the background for people eventually. We don't necessarily know right now, for example, when you use, your email, what email service that you're using on the internet, what protocol does it go through? That's all done on the back end. And so these are the types of products that we are looking at and investing in. And so right now, we're not necessarily considering them, for today's metrics in terms of each of these projects has some revenue, but the revenue overall is not indicative of, their valuation today or their future growth potential. And I think that's kind of what we want to drive home with like these Web3 protocols is that a lot of them have some revenue, they have some traction, but that is not kind of the way to value them, to get, to say, hey, based on their earnings right now, they should be valued at this. You kind of need to take the earnings in combination with this is the growth they have and the fact that this is potentially in the future, the market they could capture. And you need to say, we believe that these types of protocols are going to grow into these valuations in the future. And so that is kind of how we think or frame our thinking around Web3 and the growth in that sector. So as an example, Peter, if you would go to the next slide, thank you. So Arweave is a great example. Arweave is a decentralized storage. And, one thing that they've been doing recently is that they've actually been partnering with every other blockchain and storing the history of those different blockchains on the Arweave network, which is pretty important. I don't want to get into too many technicals, but a huge issue that a lot of these high performance blockchains are encountering is that they don't have the ability to store all their transaction data. And they don't want to be putting that transaction data in a centralized repository, such as AWS, because that relies on Web 2. But a Web 3 option is much more preferable. So Arweave, as an example, is really great here. We really like Arweave, but the valuation for Arweave fully diluted is in a couple $1 billion, but to date, its total revenue is just over $1 million. And so a lot of investors would probably shy away from that and say, oh, totally overvalued just based on the revenue. But that isn't exact, that we really try to not kind of silo projects looking just at those types of metrics. We look at other numbers too. So just as an example, for Arweave specifically, we've been looking at their monthly transaction growth. And as you can kind of see, they really hit hockey stick growth starting last summer. And actually before that, I wish this was on a logarithmic scale, but that chart, even before that was, displaying really strong growth month over month. So year over year, we end up with, transaction growing on average 67%, which is to us, indicating increased usage of the network. So while that might not be reflected today in their revenue, we believe that you need to look at not just the revenue for these projects, but also some of the other metrics, such as transactions, such as user growth or growth in accounts, growth in Arweave's case, the amount of data stored. And we kind of take all those numbers in combination with the revenue to understand what the future potential could be for projects like Arweave and what valuation it should have today based on the future growth potential of the network.
And some of it also, I'd imagine, Katie, you have different, not necessarily structures, but different terms or features, that are into each token, right? Because you can have, one of the things I think is, kind of interesting to think about is not only do you have to look at the actual business, right? Is this a good business, good metrics? Fundamentally, does this look like a strong business? But unlike, equity, where it all kind of is very overt where it flows, you have to actually look at the structure of the token, almost like a bond. What features does it have? So like, how does that economic value actually accrue to token holders? So one could even look at valuation and say, okay, well, Arweave is trading at some insane multiple on price to sales, right? Which is partially warranted just based on the potential, but also partially based on because you don't actually own the equity in the business. There's other drivers associated with how the token is structured that will lead to price appreciation over time. So it can be Web3 or not, but when you and the team look at kind of that all-encompassing picture, how do you think about token structure and value accrual?
Yeah, I mean, that's a great point. That's very important. Definitely understanding kind of the supply and demand features of each of these tokens. So as kind of Jeff talked about earlier, amortizing tokens, is there some sort of a token burn or a supply sink that would lock up tokens? Many networks right now require staking. And in some cases you have to look at, okay, like what percentage of the supply is going to be staked versus what is the new issuance. In the case of Arweave, they're a proof of work blockchain. And so they are mining and producing some new tokens, but very few relative to kind of what is the current supply. So the emission rate is pretty low. You look at something like a Helium, where in order to use the network, you actually have to exchange Helium tokens for data credits, and then you can use those to pay for your internet access, essentially. And so again, in that case, you have like this mint and burn function on their network. So yeah, these are kind of like all the considerations that we give when we're examining these tokens and understanding how to value them and how to think through what their future value is and what their current value is.
Perfect. Thanks, Katie. And we have a question I think that we'll kind of answer in this next section that Alex is going to lead us in. But just kind of walking through a more specific valuation methodology, almost like a case study here. So for that, I'm going to kick it over to Alex to talk through way in which we look at the DeFi gaming sector and get into a very specific example around Axie Infinity, a name we know really well. So Alex.
Yeah, thanks, Peter. And just for some context, I typically cover DeFi and part of the gaming sectors, which is lucky for me because these are the ones that most resemble traditional early and mid-stage businesses. So over the last couple of years, as DeFi has really hit product market fit, there's been numerous websites and numerous tools that have started tracking revenues and user data. And this is all super important to plug into really the traditional valuation metrics that you guys are familiar with, and using earnings models, relative valuations, DCFs, all to really derive where we think fair value is for a lot of these different tokens. So going into the next slide, we really wanted to use Axie Infinity here as a case study because this is such an interesting case of why valuation is so important. So just for high level how Axie works, Axie is a digital asset-based game that really made the play to earn theme popular. We've seen numerous projects raise and begin developing after really the success of Axie. So kind of the walk through the flow of how to use Axie and where the value flows for Axie. A user would purchase Axies. These are essentially Pokemon-like creatures that you can team up and then battle other teams with. For each time you win a battle, you would earn, the user would earn SLP for winning the matches. SLP can be bought, sold, and also used to breed breed more Axies, which could then also be sold. And then Axie Infinity itself, the company behind it and the project behind it, earns a breeding fee every time, earns a fee every time a new Axie is bred, as well as a marketplace fee anytime someone purchases new Axies on the marketplace. So that's how it works. Sorry, Peter, go back just for a second. I want to highlight a couple key metrics. And Axie itself has seen really exponential growth over the past 2 years. As you can see in Q1 of last year, at about 10,000 users, and it ended the year with over 2.4 million daily active users on average. This has clearly been reflected in its revenue, growing from less than $1 million in Q1 to, marketplace revenue growing from less than $1 million in Q1 all the way to its high in Q3 of 87 million. And then same with breeding, which is their main driver of revenue, reaching almost $700 million. And so this growth has been extremely exceptional. But what I really want to highlight here is the complete fall in revenues and from Q4 to Q1. And that's kind of what I want to dive in and why I think valuation is so important here. So what happened? What went wrong for Axie? So as I mentioned before, SLP, you earn SLP for winning matches. So that could be what you earn. That's essentially what a user earns for playing the game. Well, over the course of last year, from Q3 to today, the price of SLP fell from 39 cents to $0.015. And this has had numerous effects across their entire business line. So from the user standpoint, starting at the top, users earn less from playing the game. This means they're not going to continue to see high growth in daily active users, and the current daily active users aren't going to be playing as much because they're not earning as much. This has then led to the cost of breeding declining because because there's a fee for breeding in the form of SLP. So the cost of breeding declined significantly for people who are actively breeding these Axies. Because there's less demand and the cost of breeding declined, the supply of Axies in the market shot up significantly. This led to a fall in the Axie floor price, and which ultimately led to a decline in breeding margins. So if we go back to the previous slide real fast, Peter, we'll see that there's a line here. Number of breeds fell from 4 million to right around 250,000 over the course of Q4 to Q1. So this is very far fall in activity on the metric, on the network. And then because there is such a lack of breeding, Axie's revenues fell significantly. And because users were earning so much less, Axie was forced to try to add new supply sinks to SLP. So what they did here was raise the cost of breeding in order to burn more SLP to try to keep the price as high as possible, to not have users' earnings go to zero and ruin the play to earn mechanics. But it only held SLP flat around $0.015. So users continued to decline as SLP's price did not increase. They weren't earning as much still. And actually, probably the most important metric here is that the breeder's margin went negative for the first time. And all of this culminated in Axie's breeding revenue falling, its largest source of revenue falling 95% quarter over quarter. So if you go to the next slide, Peter. And why is this important? So for valuations in this space, even though we are able to use traditional valuation metrics, earnings models, DCF models, it's still more of an art than a science. And the most important parts are figuring out inputs and really doing robust sensitivity analysis around what can happen within these networks. So we were lucky enough to have a case where we were we were seeing what happens to our earnings model if SLP's price fell significantly. But as you can see, revenues have just completely fallen off a cliff, and there's no real clear path to get them back, to really grow them back. So what I want to highlight here is understand the key inputs enables us to project forward earnings, revenues, and applying some sort of multiple that is in line with the sector. And then sensitivity analysis of how these systems work with SLP, understanding all the key inputs, really allows us to capture the flywheel as it's growing, the revenue flywheel as it's growing, and avoid risk as some of the key red flags begin showing up within the network.
Thanks, Alex. And, I think it's important to show everyone, we do have, a snapshot of our model and how we look at it. And in this chart you're seeing here, even though the fundamentals don't always, mirror the actual performance of the token, there are a lot of kind of attributes that lead, price direction with the fundamentals. Just because Axie is a little complicated, because you not only have a parent company, Sky Mavis, which is a big Andreessen Horowitz funded company. They've produced a game, Axie Infinity. Axie has its own token, and then it also has an in-game currency, which you mentioned of kind of SLP. That's obviously a lot to look at. The kind of ongoing mechanics of how all three of those relate and coincide. How do you just take Axie for example? How do you think about the economic value accretion to the Axie token holder, because you do have a centralized parent company that owns the actual game, right? So how do we kind of think about that valuation?
Yeah, so Axie is kind of more is most likely an asset-backed token that Jeff described earlier. So what happens anytime ETH is used on the marketplace, or Axie AXS token is used to breed, those both flow to the treasury, in which in the future Axie tokens will have governance rights over.
Perfect. Thank you. And look, I know we've got a lot of questions, things coming in chat, stuff like that. Where we are coming up on time, and I want to be respectful of that. So, if anyone does have any questions, certainly feel free to reach out after the call, and we will, of course, share these replays. So on the next slide, I'm going to go back to Jeff, and I think this is something that's pretty interesting, is, we have all these different ways of looking at, attributes of traditional valuation, and some of them are very similar in the digital assets world. So this slide really serves as a comparison of those two. So I'm going to kick it over to Jeff to kind of walk through some of these.
Yeah, thanks again, Peter. And I think, even before getting into yours, I think some of the things that we heard from Katie and from Nick and from Alex, hopefully it's clear by now that, even though most of the people in the space, all they ever talk about is the technology, right? They talk about the network, they talk about the tech. I think it's clear you don't necessarily need to even understand the technology to value and invest in this space. In the same way that you don't have to be a mechanic to buy auto stocks. You don't have to be a doctor to buy healthcare stocks. In the same way that you don't necessarily have to understand exactly how Netflix's algorithms work to buy Netflix stock. That's the same thing that we're trying to get across here as well, is that the technology is great, but ultimately fundamentals matter, which is the user growth, the transactions, the revenues, the cash flows, and the way that all that accrues back to the token. So in terms of just going back to these tradfi analogies or traditional finance analogies, you start to then create a vernacular as well that, can be confusing at first, but ultimately just becomes second nature. So, drawing some of these parallels back to what we're used to can help make this space a little less intimidating as well. So for instance, you've heard staking, 100 times now about what that is. Really, staking is just a dividend yield, right? The mechanics of what you do while you're staking is obviously differently. But from a financial standpoint, the staking yield is the dividend yield. Similarly, we talk about rewards all the time, and all this inflationary rewards and money that's coming from DeFi and other applications. best way to think about that is just as a customer bonus, right? You know, go back to like Ally Bank 10 years ago when they were paying a full 1 to 1.5% higher on deposits than every other bank in the country, right? All they're doing is that's just a marketing expense, right? That's a customer bonus. It's the same thing with DeFi rewards are, right? They're paying you to be an early customer to get involved in their network, in which case that becomes, you know, SG&A or just a marketing expense. You know, token burns, right? Token burns is just a stock buyback. It is just a way of reducing the outstanding circulating supply of the asset that you're purchasing. You know, supply schedules, right? You've probably seen in many decks now, you see the pie chart or the bar chart with all the different ways that the supply unlocks. It's the best way to think about that is just as a shelf registration, right? If you issue unsecured debt and you have more room under your covenants to issue more, or if you issue stock, but you have a shelf registration to issue more stock, it's the same thing. The only difference is a lot of times the supply is mapped out ahead of time instead of being at the mercy of the board or of the CEO to kind of do as they see fit. It's actually better in the sense that you have full visibility into what that supply schedule looks like. One of my favorites in terms of drawing parallels is, talk about real-time blockchain explorers, everything from Etherscan to others on other blockchains that you may or not be familiar with, as well as, we just wrote a blog last week talking about, a lot of the different sources that we use to get information. This is all just publicly available information that if you know how to read a block explorer, you know how to program an API, you can get this information at your fingertips. It's the equivalent of an 8K, but instead of coming out again, kind of randomly, at the company's discretion, you get this stuff in real time, right? All the information Alex was just going over on Axie, we get real-time information. All the stuff on Arweave, real-time information. This is a better asset class for investing than debt and equities. Instead of waiting, imagine if something happens on April 1st, you might not find out about it until July 20th, right? 3 months later when they report quarterly earnings and put a 10Q out there. We get this stuff that day. So it's a much more transparent way to invest with regard to the information coming through. Protocol revenue, very similar to gross margin, right? Just looking at the cost of block space relative to the fees that are coming in, the same way that you would look at revenues versus cost of goods sold. TVL, total value locked. You probably hear this 1,000 times. All TVL is deposits, right? It's just the assets that are being deposited into a bank or into a financial services. So, there's a lot more of these that we didn't put on the slide, but the idea here is if you start to think more in traditional finance terms, a lot of what's happening in digital assets is no different. We're just calling it something different.
Perfect. Well, thank you, Jeff and Katie, Nick, Alex, and everyone who took the time to dial in today. We will, of course, have the replay and deck available. And again, any questions, you can use the email there. You can also email ir@ar.ca, and I or someone from my team will be happy to help. If I didn't get to your questions, and there were a bunch of them, I apologize, but we do these a lot. So thank you so much, everyone, and have a great rest of your week.